Good afternoon. This is Canada Tortoise Capital with a review of the weekend trading report for March 17th, 2018. Market is in bullish normal conditions, just came down from bullish volatile. We're in the middle of the trading ranges on an annual basis using weekly RSI 14 and on a 10-day basis using NDX 10. In the market mosaic, we are yellow bullish on some weakness this week. In price relative to the 200-day moving average. Slope of the 50 weakened somewhat to red bullish at 0.22. ADX is a non-trending 17.3. The risk index is the 30-period moving average of the VIX divided by the 10. 1.0 is the boundary between risk on and risk off. We are at 1.257 deep into risk on, favoring the riskier long side assets. The z-score of that risk index is computed by looking at the last 5,000 trading days, finding the average and standard deviation, and computing the z-score. It's currently at 2.78, so extraordinarily high on the risk Z. And you can see the 90-day histogram here. This has been a favorable run for swing trading, going from deeply volatile to much less. Blended month rebalancing, you see the holdings for March. Next reevaluation is due on or about 1 April. These are the leaders in the clubhouse based on closing prices on Friday. In ETF2, the theoretical exposure is at 60%. Here's just a quick look at blended monthly rebalancing portfolios for various portfolios, 13 ETFs and the 32 ETFs. See about half and half on buy signals, half on cash. That's computed by looking at price with respect to the 4-month moving average. Leaders are remaining technology, Latin America, emerging markets. In the Dow 30, Cisco and Intel remain at the top, had a favorable move here this week in Caterpillar and United Health. Walmart and McDonald's, who had been on the downside longer term, so there may be some value plays going on. I would be looking for those to continue their rebound, and I'll be framing those trades for momentum plays from the deep discount perspective. In the sector spiders, in business sectors, again about 50-50. Healthcare and transportation kind of held their own, and notice that there was some recovery down here in the bottom stack, maybe a rotation to some deep value plays. Real estate has continued to do pretty well. In the ETF Max, this is looking at 500 ETFs or so, and you can see the clear winners. Cocoa has had an amazing month, cooled off somewhat this week, if I may say it that way. In the market health check, the vertical blue lines are 10, 20, and 30 days worth of look back. Here's 40, 50, and 60. The horizontal purple lines are price targets to the upside. Horizontal red lines once were resistance are now support. These are price targets on the way down. It's holding right now at 274.5. If it continues to hold here and then resumes, then we would have a low, a higher low, and a second higher low in the baby dragon, and that would be very favorable, poised for a run back up at the swing high at 283. The dragon is sloping up. The downward slope of the 30 of the river is cooling off. It is becoming more flat. The P-star is still pointing to the upside, as is the MACD histogram, still above the zero line. We've come off a period of overbought and are finding support here around the middle of the Williams percent R. We're only 4% off the swing high, so we've recovered from this run down to -10. The slope of the 30 regression line has improved, has now crossed the zero line, and is now favorable. You can see the 10 period RAF regression channel sloping up and the 30 period sloping up. So this is healing action that's been going on. The size of the sell-off compared to the next 3 days of selling to the last 3 or 4 days of selling, the bears are diminishing in strength, and so this week will really tell us if this Bollinger Band mean is going to be support and it resumes. That's my expectation, but we'll see how it plays out in price. ETF regional report. 6 of the regional indexes are on buy signals, 4 are on cash. That leaves us at 60-40 in the allocation model. The S&P at 49 is stronger than EFA at 38, so the U.S. is still favored over the globals. Inside the U.S., it's technology, then small caps, then a tie between the large and the mids. 2 strongest sectors, Latin America and U.S. tech. 2 weakest sectors, Asia less Japan and Europe. Inside the 9 sector spiders, strength in technology and discretionary, weakness in staples and utilities, continuing that trend. World market model, generally the U.S. very favorable with real strength localized here in the technology large caps. Europe weak. Asia a mixed bag with great strength in China but weakness in India and Philippines. Another divergence here in the Western Hemisphere, Brazil great, Mexico below average, Canada horrible. That corresponds with some weakness here in the other asset classes that you see. Again, a mixed bag. Oil strong, real estate has been weak. That's why this little rebound in real estate has been particularly gratifying. ETF top 30. I sent out a quiz this weekend to kind of show how to interpret the strength and consistency columns. Let's go to that right now. So strength is a blended measure of 3 and 6 month lookbacks. And consistency is a 10-week moving average of strength. So those are all scored on 0 to 100. And so strength is kind of the current blended relative strength, and consistency, again, is that blended form of that. When they're both green, the purpose of this quiz is to say, how can we think about something that is short-term and longer-term? What's the assessment? What kind of swing strategy would we have? Is that a good candidate to play as an intraday turbo? And if so, why so? And if not, why not? And so the combinations are strong and strong, green and white and green, etc., all the way down. And in general, what you can say is that when we apply statistics to those large populations, that and we rank them on an index score of 0 to 100, we find the average and then take the standard deviation, and then everything that's above average to above average plus 1 SD gets coded as white. Things that are more than 1 standard deviation above average, I classify as green, and they're great. And then same for weak and bad. So when you apply statistics to describe populations like this, generally what you're going to see is about 1/6 or 15%-ish of that population will be in the green, about 1/3 in the good, 1/3 in the weak, 1/6 in the bad. So you get that kind of distribution. So 2/3 of them are in this white and yellow category, regardless of the column here, but 2/3, and then 1/6 and 1/6. And so if I take the 10-week average as the long-term condition, the smooth condition, and then the most recent one as being the current. And so I'll be sharing the results of this one with the advanced swing course. But based on how these categories work, we can form assessments and strategies associated with the condition for our symbols in our populations. As an example, All these that are green and green have been long-term good and short-term good. That's pretty good. So the Internet Index, oil, semiconductors, and so on. These that are green and white, so last week they'd have been white, and this week they just moved up into the strong category. So that would seem to me to be an acceleration of goodness, beginning to move to the front of the pack. And so I might have a different strategy with a candidate like that than something that has been already recognized as great over the last 10 weeks and with its current strength. Whereas something that is like finance, white and then green, was exceptional and is starting to slow down. So that's three different categories right there, just among the strength leaders, that might cause me to green, 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 white, and white, green, that there's a distinction in our assessment, and there might be a distinction in the strategy that we apply. Things that I'm interested in typically are green and white, because this is the emerging strength just beginning their sprint, if you will. So I would frame those as continued breakouts to the upside. I would really want to emphasize the longer term. These that are white and green are starting to cool off, in my view, and one of two things could be there. It could be the pause that refreshes, and now I can buy financials on a dip, or it may be that the run is done and I want to make sure at least I'm preserving the profit and maybe playing this for the downside, or moving capital elsewhere and stop being overweight that sector. And so the Vanguard financials is seen in the same category. So that's the intent of this this quiz, is to clarify our thinking on how to use that set of heuristics. Looking at the liquidity stats, again, this is just the top 30 ETFs on the basis of average daily dollar volume, which is average volume times the current price, gives you the dollars being transacted directly in that ETF. And again, technology, twice the size now of the Russell 2000. 2 years ago, it was almost the opposite. So this is a resurgence of interest in tech trading over the last 6 months. Shifting to the daily. No signals and channeling an overreaction. DuPont, the Dow-DuPont merger, now leading the way in max pain. Boeing, which had been an exceptional relative strength leader, is now in the max pain, cooling off, if you will. Intel and United Tech both had interesting weeks and are on the short list for trade framing, and you can see the other candidates as well. Dow Tactical Summary, lots of 551Ws based on some gains on Friday going into the weekend. Still plenty to choose from here in the auto framer, and quite a few dojis emerging. United Tech is of interest to me with its RSI2 in the single digits, along with Coca-Cola. Coke is interesting to me. It was a big percent loser on Friday. Even though it had gains, it didn't gain as much as the rest of the market. So you might attribute the 1.4% gains to the fact that it's a member of the Dow and people were buying the Dow, but not as many people piling on Coke either. Whereas something like Boeing, which has been negative, then had a nice some positive moves on Friday as well. Actually, yeah, it also didn't produce as much as Coke. ETF 30 tactical, lots of RSI2s, a handful of assorted swing symbols, lots of 551Ws, plenty of symbols that test out well in the auto framer. Oil and metals and mining look to be interesting. In the pinch and stretch, real estate, although long-term weak, has put in some nice moves compared to its Bollinger Band mean. So I'm looking for either a continuation or a reversal on something that has outperformed relative to its own benchmark, if you will, compared to the stack. Otherwise, look at tech dominating across the board, and small cap still inside the three U.S. sectors here: the large, small, and then the Dow. The Russell has been the better of the indexes, if you will. Negatives, Z stretches, the ones furthest below their own Bollinger Band mean: Boeing, Dow, Walmart, Materials, and Home Depot. So again, these can be looked at in terms of continuing to fail or the possibility of a reversal on a buy quality on dip. These are among the favorite ones I have on my list because psychologically I find it easier to buy value that is resuming its rightful place near the top rather than, say, runaway gains. Just a psychological element involved there. The most expanded pinch boxes, these are the ones that have had the strongest directional trend over the last 30 days and have the widest river. And that's an indication of a strong directional move. And then this is relative to their own width. So extraordinarily large directional trends for all of these. The SPY is still in that category. Only gold and silver test out on the super pinches. You can see that it's the opposite of the expanded pinch box. These are the compressed rivers. So 30 days of exceptionally sideways movement with less volatility than usual leads to a very narrow river, which gives you these kinds of scores. And these are the ones that I frame on the basis of being prepared for a breakout in either direction. So I'll be framing those as potential Z3Ps. None in the auto framer. The regression line fractal framework, the ones in the green on the top shelf, the symbols that are the most ATR below their own RL270, these are the value plays. And this column, reward to risk, is how many ATRs they are away from their RL270. And then bottom shelf in the red, these are the ones that are the most overheated. And this is, again, how many ATRs they are in front of or above their RL270. No squeezes. Quick look at the market mosaic. Still generally up. The pullback has been less than it has in the previous two. That's the regression line is favorable. It's still well ahead of its own 10-period moving average compared to the long-term historical. This is back into favorable territory in terms of the gains of the last 30 days. It looks to me like the market has recovered from this testing and stabilized now right along the long-term average for price relative to the 200 days. So in my view, the exaggerated bull, the scare is over, and now kind of back to the long-term average. So I'm cautiously optimistic here. This is now becoming a actually pretty good 30-day stretch when you look at it over the historical context. It's more than one standard deviation above long-term average. This has actually been a pretty good 30 days. Doesn't necessarily feel like that, though, but that's part of the memory of that scare lingers in our minds. So that's what that last 30 days looks like, and that's actually pretty good on a point-to-point basis, although the path getting there made it feel really painful. So the slope of the 30 has now come out of the river. The 10 has pulled back, but is still above the middle of its Bollinger Band. And the 90 remains at the top of this Z-square river. So still a strong bull. The shorter-term health has stabilized, and this little pullback has provided a buy and dip opportunity. So it could be a low, a higher low, and a higher low again. And so that's what I'm... would not be surprised to see a retest of the swing high at 284. And that's everything I wanted to cover for today. Just to throw the rest of these here for you to glance through, should you be moved to do so for intraday trading. Notice the relative strength of technology in the 10, 20, and 40-day holding periods. And again, just our reference data. All right, this is Ken at Torres Capital. Keep your risk measured and your powder dry.